All right, it's Christmas Eve, everyone. Merry Christmas. I bought more shares today of 3M, ticker symbol MMM. I'm going to talk about that in today's video. I've been receiving a lot of questions about real estate investment trusts or REITs and how they work, how to look at funds from operations. So I'm going to talk about one of those in today's video, Realty Income. I'm going to go through some financial analysis to explain funds from operations to everyone. Unilever, another stock that I own, consumer non-cyclical, recently adjusted their forward guidance on revenue. The stock tanked, think about 9% in a single day. So I want to talk about that stock today as well. And I've been getting a lot of questions. It's a new year coming up. 2020 is on the horizon. And some investors, I would say a lot of investors, are starting to feel anxious. They have some anxiety. I'm not only talking about people who've been in the market a while, but also new investors. They're feeling a little bit anxious about deploying money and approaching the stock market. And so I want to talk about that as well in today's video. And I'm going to weave some anecdotes throughout the video today on that topic of investing, what investing means to me, why I don't have anxiety these days as an investor. So we'll talk about that throughout the video today as well. It's a special holiday edition of PPC Ian. I want to wish everyone out there a Merry Christmas, a Happy New Year. I love you all. Get ready. It's another video about dividend stock investing. So let's start with the fun stuff. One of my favorite things in the whole world is buying stock. I had the opportunity today because the New York Stock Exchange was open for a half day, an abbreviated trading day, but it was still open. I took that opportunity to buy more shares of 3M, ticker symbol MMM. So I want to pop that ticker on the screen right now. I want to pop the information on the screen about my purchase today. And you will see that I bought more shares at $176.73. Boy, it is up from the lows, but hey, I'm still buying here. It is a goal of mine in 2019 to buy top 10, top 15 stocks, and also to double down on value and industrials. And so this stock is the poster child for my 2019 goals, and the year is not over, so I want to continue to buy more. The 2019 estimated earnings per share from the analysts, the consensus estimate is $9.05. 2020 is $9.64. That places our forward PE on 3M for 2019 at a 19.53 and 2020 at an 18.33. No longer is this stock, in my opinion, a value. It is trading, I would say, at an attractive price, a fair price, if you will. That being said, overall, stock market is pretty lofty here. A lot of companies, especially world-class brands like 3M, they're kind of trading, I would say, richly valued, if not overvalued. And so to buy 3M at a fair valuation, that is music to my ears, and that's why I bought more of it today. Also, the worth noting, the recent high on 3M was $258.63. This was in early 2018. So we're still down 32% from the recent high. A lot of that is because this industrial has been facing some turmoil as we get really late into this market cycle. And quite frankly, with trade wars as well weighing on them a bit. And so it's still down from the high. And usually I don't place too much weight on where a stock has been versus where it is now. But with something like 3M, it's always a nice indicator just to see, hey, it's not reaching new highs yet. It is still down a whopping 32%. And so the dividend per quarter is $144. You multiply that by 4, you get $576. That is the dividends per year from this company. So the starting yield that I locked in today is 3.26%. Not huge, but and certainly not as much aligned with what I'm trying to do in 2020. 2020 is going to be a year of high yielders for me, but certainly an attractive yield for 3M. 5-year dividend compound annual growth rate is 11%. They've raised the dividend on average by 11% for the last 5 increases. And the last increase was 5.9%, so a little bit lower than the 5-year, a lot lower than the 5-year compound annual growth rate. And quite frankly, that lower clip is probably where investors are well served to model 3M in the coming years as they kind of get through this part of the market cycle and reemerge in a new growth pattern in future years. But I do expect the dividend growth rate to be a little bit lower in coming years. And so I also want to show on the screen some historicals, because this time of year, look, we're headed into the new year, and it's always good to reflect on the past. What has happened in the past? And so, yeah, I bought today at 176, but what are some of the better prices that I got? And so I started looking at my account. I started looking, what are some of the other 3M trades that I made in 2019? And you can see here, I bought in October, very recently, 2019, at 151.64, so I'm already up 17% on that tranche. And I bought in June also of 2019 for 160.51. I'm up 10% on that tranche. And so I bought a lot of tranches of 3M throughout the year, but these are just 2 of the better ones. And so this puts things into perspective as well. Look, I'm only up 17% on my best tranche, 10% on my second best tranche. And so it has not gone up that much materially to get me to stop buying this thing. And so quite frankly, I still think it's a reasonable time to buy. That's why I did it. I love the quality of this. I love it's a top 10 stock, world-class company. I want more exposure to industrials. And quite frankly, I probably won't be buying any more tranches here in 2019. I got to be mindful of my cash flow management. But as we transition into 2020 now, honestly, my goals are towards high-yielding stocks, but I might pick up another 1 or 2 tranches of 3M because, like I said, it has not recovered yet. It is only up 17% from my best purchase price. That is not that much. It's still more or less in that same range. And so that was exciting. And now I wanted to share something because there's this whole notion of investing anxiety, worrying about stocks going down, worrying about investing. And I wanted to share some nuggets of wisdom in today's video that I think could help the community. Not only people who are anxious, but also just everyone, because I've been thinking really about investing recently on a spiritual basis. And I even got thinking today, I had to buy today, and I'll tell you why I bought today. I bought today because you start thinking the market is open. What does that really mean? You know what it means is teams of people that work at the New York Stock Exchange are working today on a day that a lot of people have off. A lot of people aren't working. They are working, and they are working hard, so dividend investors like you and me can actually trade. When you come to think of that, it is absolutely amazing. And it's not only the NYSE. The NYSE works with what are called market makers. And these market makers are literally the firms facilitating the trades. If you go to their website, it lists all the market makers, the big ones that they work with. They're all working today. And so I start thinking about this, and I start thinking about the world and how we're all connected, and that everyone honestly out there is doing really, really important work. The work that is happening at NYSE, the work that is happening with these market makers, maybe they don't get praised all the time. Maybe some people look down on quote unquote Wall Street. I heard I don't want to get into politics, but I heard something about a certain politician recently saying, let's tax Wall Street. There's all this pessimism about Wall Street. Well, I start thinking, what is Wall Street doing? It's freaking amazing what Wall Street is doing. And so anyways, this gets to kind of the, this will make more sense by the end of the video, but I want to include some of these nuggets of wisdom as we go. Because quite frankly, I had to make a trade today to support the amazing men and women who are working so hard today to make it possible for me to even do these trades. It's amazing. It is a blessing. It is an honor to be able to trade stock today. And I thank you. If you work on Wall Street and you're actually making markets, bless you and thank you for what you do for society. It is amazing. All right. So that was just a quick update on 3M that I bought today. I want to move now. I want to get into some financial analysis. I have been receiving questions a lot of questions about real estate investment trusts because it's confusing. We just looked at 3M, and one of the ratios, one of the most important metrics that I look at is the price earnings ratio. I take the price per share, I divide by the earnings per share, I get the PE. Well, when you look at real estate investment trusts, it doesn't really work that way because earnings per share is really skewed. It is really misleading in many ways. And so you look at PEs for real estate investment trusts and they seem sky high. They seem really high. Why is that? I'll tell you, GAAP earnings per share includes amortization and depreciation. It doesn't back that out. Rather, the amortization and depreciation, it is subtracted out of earnings. So earnings are after depreciation and amortization, and so it skews earnings low. And again, you have a numerator, which is the price per share. You divide by earnings per share. If earnings per share is artificially lower than it otherwise really is, it makes the PE look a lot higher. It looks a lot higher and more misleading. And anyways, there's this concept of funds from operation, adjusted funds from operation. This is called FFO, AFFO, that is used with real estate investment trusts. I want to talk about that today. I want to talk about that concept because I get so many questions about it. And I own Realty Income. It has been a home run for me. It has been an amazing investment. I'm going to talk about that. I work in the real estate field as well. And so that has helped with my own education as it pertains to this stuff as well. And so anyways, how do I want to do this? I probably want to start just on the screen right now with some metrics. We're going to start with the high level, and then I'm going to get into some of the more detailed level metrics as it pertains to Realty Income. Ticker symbol O, the monthly dividend company. They pay dividends every month, by the way. I'll link in the description below. I've done some videos on that topic before because I know a lot of folks out there interested in monthly dividends. Anyways, Realty Income. So let me pull this up on my own laptop here. Okay, it's currently trading at $72.36 per share. And you'll see here, I for this analysis, I used the 2018 numbers. I'm just pulling past data. I'm pulling it from their annual report. And I am doing that to make my life a little bit easier because the annual report has the best financial analysis in it. So some of these numbers are delayed because now we're at the end of 2019. But the point of this is the education of it all. It is the same. All right. 2018 earnings per share were $1.26. Okay, if I take $72.36, the price per share, I divide by $1.26, the PE for 2018, again, looking way backwards, it's a 57. Oh my goodness, it's quote unquote overvalued. No, it is not, because that earnings per share is misleading. Let's now look at another metric, the AFFO, adjusted funds from operations. That one, which basically adds back in depreciation and amortization, the phantom income, if you will, comes up to $3.19. If I take the $72.36 price per share, I divide by 3.19, I get a 2018 price per share divided by AFFO of 22.68. So the kind of the comparable to PE in the world of REITs, I would say, is this very metric, price divided by AFFO or FFO, if AFFO, the adjusted, does not exist. And so you're kind of getting a PE here backwards looking of 22, and you can see how different that is than the high-level PE that a lot of people pull from Yahoo Finance or other websites, which can be misleading for REITs because it shows 57. By the way, I just include the dividend stuff in here, $2.74 per year, and they do pay their dividends monthly. And starting yield is a 3.78%. Not very high for this REIT. I am not buying here. I think it's fairly valued, maybe a little bit overvalued, but certainly not on discount. By the way, just because I'm kind of in the mood of looking at things retrospectively, year end, looking forward to the new year, trying to set the stage here for 2020, if you will, let's look at some past purchases. I'll share that on the screen right now. And so I purchased, these are some of my best tranches. Most of my tranches, though, were in the 30s and 40s. And I purchased in August of 2013. I purchased for $42.83. And so I'm up 69% on that tranche. And my yield on cost on that tranche, simple, not including reinvested dividends, is a 6.4%. 6.4% is a lot different than the starting yield right now of 3.78. This just goes to show the power of dividend growth investing. My better tranche, actually, from December of the same year, 2013, was at $36.81. I'm up 97% on that tranche with a simple yield on cost of 7.4%. And so I want to just show this because I want to give a flavor of what is possible with dividend investing. And I know a lot of investors looking forward to the new year, trying to set strategy for the new year. There's kind of some anxiety. Well, when I look retrospectively, and I especially look over a multi-year period, you can quickly see how things tend to, at least historically, they've worked. Now, I'll tell you, we are towards the end of the bull market. Things in the future may not be the way they have been, but my big take home for myself in particular is even if the markets go down in the short run, when I look over long periods of time, the trend tends to be up and to the right as long as I select world-class companies like Realty Income. And so before I move on here, I just want to define terms. What is amortization and depreciation? And so when you are in the world of real estate, you own buildings, you rent out buildings. What happens is the building itself, on paper at least, for tax purposes, loses money over time. That is depreciation. Amortization is the equivalent of the depreciation, to my understanding, but for non-tangible, non-physical real estate assets. That applies to trademarks and such. But basically, amortization and depreciation, we'll see in a minute for Realty Income, it is huge. But the way GAAP accounting works is the EPS is after depreciation and amortization is subtracted out. And so the GAAP generally accepted accounting principles that are used to derive earnings per share in the United States, they're post amortization and depreciation. But in the real estate world, the question becomes, is this amortization and depreciation real? Is the company really taking a charge for that? Are they really losing money for that? No, it is literally a tax code that allows these companies to take a real estate asset and lower its value over time. They literally depreciate it. There's depreciation schedules. It depreciates over time. Even better, as a shareholder in companies like this, the depreciation actually gets passed through, and that depreciation is considered a return of capital, so that portion of the dividend is not taxed. And so get this, I'm actually going to share this on the screen right now. I have a few more things I want to point out as it pertains to REITs because it's so darn confusing. And I apologize if this is confusing. Some of you might have to watch this more than once. It takes a while. It took me a while to wrap my head around this. And I know even as I'm explaining it, I can tell it's kind of confusing. And so hang in with me. There are some serious nuggets of knowledge here. But check this out. This is my real estate investment trust cheat sheet. The way REITs work, they're not taxed at a corporate level. They avoid double taxation by flowing through everything to the shareholder level. Now, 90% of earnings, by the way, must be distributed as dividends. So I love REITs as well because they are forced by the code to be a REIT. You have to distribute your earnings as dividends, which is awesome because I invest for cash flow that I can use to pay bills. So they're right up my alley for what I do. That's why I have a huge position in Realty Income. When you receive a dividend from Realty Income or any other REIT, and you receive your tax paperwork at the end of the year, there are two components of the dividend. One component of it is literally just taxable dividends. It's typical dividends you're taxed on. But the other component of it is return of capital. And so what's so interesting with this return of capital, this is the depreciation portion. What happens is the return of capital, that is not taxed. And so there's a portion of cash flow that comes from real estate investment trusts that is not taxed. It's tax advantageous. And now when the capital is returned, you do have to step down your cost basis because of that return of capital. And if you are ever to sell, the capital gains that are paid are from the stepped down basis versus where you sell. But I buy and hold forever. I never plan to sell, so that doesn't really affect me. Now, if my basis does reach the point where it is zero, then all future dividends are going to be taxed as capital gains for that portion of it. And so that is, in a nutshell, how real estate investment trusts work. Now, I want to mention something as well. 2017, there was a new tax bill, and what this tax bill did is it offers this pass-through deduction, and this is 20%. This is on the portion of the real estate investment trust dividend that is taxable, that first portion. That portion of the REIT distribution is now basically, there's a 20% deduction taken off the top because of the new tax code. And so this is one of the reasons, quite frankly, that Realty Income and some other REITs have done so well over the years since this new tax law was enacted. It has changed the dynamics of the cash flow from these real estate investment trusts. And so really, really interesting stuff. Okay, so what I want to do next is I want to move on and I want to just share some stuff on the screen. I want to share some financials. In fact, before I even share the financials, I want to just share something from the the Realty Income 10K, the annual report that I pulled. It was just fascinating, that shows its performance versus the benchmarks. And so check this out. I'm going to pop it on the screen right now. And it shows company performance, and it shows compound average annual shareholder return since 1994. You can see for Realty Income, on average, it's been 16.3%. This is all in. This is dividends, reinvested dividends, all that good stuff to my understanding. Now, you compare that to the benchmarks, such as the S&P 500, which is at 9.3%. And again, this was as December 31st, 2018. So this is about 1 year old. But it just goes to show you that so many people come here and they'll debate it all day. They'll say, why would you pick individual stocks? You can't beat the market. Realty Income is living proof that you can beat the market right here. Other people say dividend stocks, they're no good. You should be doing growth stocks. Well, check this out. Dividend stocks are beating the market. They are doing handsomely. And this is not even a typical dividend stock. It is a boring old real estate company. And so I don't find it boring, but I know some people find this kind of thing boring, but it can still crush the market. So I just have to share this. And if you're thinking about 2020 and you may have some anxiety about the market, it's probably good to have a healthy level of market anxiety, especially because we're late stage bull market. We're towards probably the end of this bull run at some point. And so it's good to be prudent and exercise caution. But at the same time, when you look at the numbers, the hard facts like this is the kind of thing that always gives me so much assurance as a long-term investor. And I'm long-term, buy and hold forever. Okay, so now let's get into the detailed stuff. I want to share some selected financial data from the annual report from Realty Income, again, from 2018. So I'm going to pop it on the screen right now. And this is the historical financial performance. It's a lot of numbers here. And so I'm not going to spend time on everything. I just want to focus on 2018. But you can see the way this works is they talk about revenue. So that's the top line. It drops down to net income real quick, actually. I guess this is just the summary, so it doesn't show all of the things that go into the calculations for net income. But basically, it drops down to 364 million. You can see, by the way, that's as compared to 107 million in 2010. Or quite frankly, 204 million in 2013. I was just showing you some tranches I bought in 2013. I'm way up. One of the reasons I'm way up is the company performance is way up since then. And because the company performance is up, the stock has gone up. And so it all ties together. And quite frankly, it's all because of the people that work at this company, the hardworking people that I invest in. This is another nugget of information. I want to take just a little bit of a tangent here. Something on my mind. Again, it's the holiday. Merry Christmas, everyone. I start thinking about this. I was on my run earlier today. It's Christmas Eve, and so I got to get my run in before I have a feast tomorrow and eat my heart out. with the Christmas holiday. But basically, I was thinking, and I love to invest in oil companies. And I started thinking, but you know what? And oil, by the way, 2020, I'll be buying more big oil. I love big oil. And you start thinking, do the employees at these oil companies get to take Christmas off? Some of them do, but not all of them. The hardworking, brave men and women operating these rigs, they don't get Christmas Day off. Maybe there's a special meal, or they get maybe different hours. Maybe they work as a team to make sure everyone gets a little time off. But they're on the rig. They're way out in the middle of the ocean, working their hearts out so that you and me can be at home and use our gas fireplace, run our gas appliances, drive our cars around. This industry, oil industry, gets such a bad reputation sometimes, and this is why I love it so much. I love it because the people that give it a bad reputation, they are wrong. They are just so wrong. This world, in my opinion, it cannot operate. Oil is energy. It is energy, and it is allowing all of us to live our daily lives. And I start thinking, what am I investing in when I invest in oil? I am investing in these hardworking men and women that are on rigs on Christmas Day doing God's work. And so I just want to give a shout out. I want to say God bless you all who work in this industry, especially the people on the ground floor. I work a half day today. I get to do my run. I get to enjoy a warm fireplace. I get to drive my car to see family for the holidays. Meanwhile, these hardworking, bless them, people that I invest in are working on the rigs. And so there's a spiritual level to what we are doing as investors, in my opinion. And when you invest, again, this goes back to the anxiety of investing. I have no anxiety about investing because I am placing my capital behind people. When you invest, you become an owner in a business, a part owner. And when you are an owner in a business, you're investing in that business. You're supporting the business. You're basically voting with your wallet, with your money, saying, I believe in this business, I believe in its people. And I just want to give a shout out to Chevron, to Royal Dutch Shell, to BP, that I believe in you. You know, some people may talk smack about the industry, but look, those same people are driving around cars. They're enjoying their gas appliances. They're enjoying the benefits of energy. And so all I'm saying, I love investing in the oil industry. Anyways, tangent here. Why am I saying all of this? I don't even know where I left off, but I just had to. It's Christmas Eve, everyone. I was trying to have some fun here today, but I was on my run and that just popped in. And I just think it's such a interesting thing to remember, that we are investing in the people. I love you guys in the oil industry. Anyways, I'm going to forget at the end of this video, so I'm going to jot this down right now to do my full disclosures on CVX, RDSA, and BP. Alrighty. Okay, so let's start looking though. Pop the metrics back on the screen. Realty income, funds from operations. Oh, it's 903 million, whereas earnings, not EPS. Total earnings were 364 million. Why is funds from operations so much higher? The reason it is so much higher is it adds back amortization and depreciation. So Realty Income, worth noting, is a triple net lease company. And being triple net lease, this is so interesting with Realty Income. They pass the operating expenses back to the person leasing the property. So the Realty Income is the landlord. Walgreens, for example, is the tenant. Walgreens, though, they're responsible with these operating expenses as it pertains to the property, including tenant improvements, keeping the building nice, painting the building, keeping it fresh, remodeling the building, all that good stuff. And so what's interesting is at a high level, tax law, it allows for the building to be depreciated. But is the building really losing value to Realty Income? Is the asset worth less over time? No, it's literally just tax code. And so again, earnings is here. It's way down here because of the fact that it's post depreciation and amortization. But if you add that back, AFFO or FFO, it's way higher. It's way higher. And this is such a cool concept for investors because, again, the depreciation, this gets all passed through. It gets passed through to, as part of the distribution to shareholders like me. And again, it is a component of the distribution that is return of capital. So it's non-taxable, but it does step down basis. It eventually becomes taxable if the basis reaches zero. Certainly matters as well if one is to sell, but I don't sell. And so you see the discrepancy. It is huge. It is massive. And again, with something like Realty Income, depreciation, just a tax concept, just totally a tax concept, because all of those tenant improvements are passed along to the people renting. That said, let's say it's not Realty Income. Let's say it's not a triple net lease company. Let's say it's a company that just owns and operates the real estate. Typically in the financial statements, there's going to be depreciation and amortization. There's going to be another line item for CapEx or capital expenditures, capital improvements. The way I look at it is still, I like to look at like an AFFO, so I add back depreciation, amortization, but I always count CapEx as real expenditure. Here, CapEx is pushed over to the people renting the property like Walgreens, but in some cases, other companies, they do their own CapEx. That, in my opinion, should always be factored as a real expense when someone is looking at a funds from operations. And so, all right, you guys get it. I'm sharing these metrics. I'm just going to see here if there's anything else worth noting on here. Well, yeah, at the bottom of this table, this big old financial summary, you can see just on a per share basis, this is where I pulled the numbers for my analysis that I showed just a while back. The net income per share is $1.26, but the funds from operations, or actually the AFFO, the adjusted funds from operations, is $3.19. AFFO versus FFO, they're pretty close. AFFO, I think the difference with Realty Income is they have some non-controlling interests in some properties, and it affects the way they do their accounting. And so that's what AFFO is, to my understanding. But FFO, AFFO, they're close enough. And you know, looking at either one, quite frankly, is directionally going to give the right ballpark direction to investors, in my very humble opinion. Okay, so I want to move on now. You know, actually, before I move on, this is important. I hear this topic all the time on my channel. Ian, they're issuing more shares. I don't like it. They're diluting me. Check this out. Common shares outstanding for Realty Income, bottom of it all, goes from 118 million up to 304. So they're raising the number of shares. But at the same time, the dividends have gone from $1.73 per share to $2.65. The AFFO has gone from $1.86 per share to $3.19. And so you quickly see that diluting shares, it's not always a bad thing. Diluting shares can be used to raise capital, and it's on a per share basis. As long as the metrics are up and to the right, on a per share basis, that's all that matters to me, in my humble opinion. I'm fine with share dilution. It does not bother me. You can raise capital a variety of ways. Two of the popular ones are diluting or issuing shares. Another one is taking out debt. And so these companies weigh which one makes more sense. But if they do issue more shares, it's important to make sure that the metrics on a per share basis are up and to the right. Anyways, I want to move on because Realty Income does a reconciliation. They do a reconciliation of the GAAP earnings per share to the AFFO, or actually to the FFO. They do to AFFO too, but the one I have to share with you today is to FFO. And so I want to pop that on the screen as well right now. Okay, and so you see at the top line right here, net income available to common shareholders, $363 million. I want to move on now to the next line. This is the most important thing in this reconciliation to FFO. It's the depreciation and amortization of $539 million. They got some other stuff in here as well. You add it all up, the FFO available funds from operations is $900 million. $900 million is a lot different than $363 million, which the GAAP numbers would lead you to believe is the case. And again, depreciation amortization, literally this is tax code depreciation amortization. It's phantom income. And so the diluted FFO here is $904 million, and that comes out to about $3.12 per share. That's the FFO. They have another table for AFFO as well that adjusts for a few other items as well. But this is the big one. This table is the important one because it shows you the magnitude of the amortization and depreciation. And so I know I'm running around a lot here today on this one, and this is a really technical and nuanced discussion. Real estate investment trusts are difficult to explain, and so I hope this answers the questions, because I know a lot of you are thinking, I got some anxiety about these things because the PE seems too high. I hope now you understand you probably ought to be looking at FFO or AFFO on these companies. A lot of people are also wondering, are they values or not right now? Realty Income, at least, it seems like it's kind of fairly trading, if not a little overvalued. I'm certainly not buying more here. But it's just so interesting on this stuff in general, from a tax standpoint at least, because the depreciation amortization is such a big piece of the pie, and because there's now the 20% deduction on the other part of the dividends, the taxable part, these things have kind of got it going on for cash flow investors. From a tax standpoint, at least, things are pretty good right now for a company like Realty Income. And so certainly for me, there's so much tax stuff going on at these companies that I also love consulting with my tax advisor each and every year. And that's kind of knowledge I want to impart as well. You're thinking about 2020, your finances might be getting more complex. You might be taking on different types of investments. Always, always, always consult with a licensed tax advisor. It is so important. Okay. Moving on, I want to talk about Unilever. I want to talk about Unilever because this is a company that I own, ticker symbol UL. And the company dropped, I think, about 9% in a single day because they came out and announced that going forward, the revenue is going to be a little softer than they were thinking. But mind you, revenue is still going to grow. It's just going to grow a little softer than they were thinking. And so I want to pop some stats on the screen right now and talk about Unilever because this is a huge position of mine. I love this company. I own a bunch of it. And so Unilever now is trading at $56.69, ticker symbol UL, and the earnings per share, the trailing 12 months earning per share is a 2.53. That puts the trailing 12 months PE at 22. So the recent high, by the way, was $64 and change, and so it's down about 12.5% from the high. And so worth noting, just a takeaway for everyone, when stocks drop in a single day, I don't get that excited just because it dropped. I have to look at the fundamentals. And the fundamentals here are, look, it's still trading at a PE of 22. It's pretty high. Maybe as it pertains to consumer non-cyclical stocks, it's one of the more attractive ones. And certainly I think that's a good point. We'll look more at that in a minute. But it's still kind of lofty, even though it came down 9% in a single day. Dividend per year is $1.81. Starting yield, it's about 3.19%. 5-year growth rate of the dividend is 4.48%, but that is denominated in US dollars, and currency fluctuations are not taken into account here. So that's just raw US dollars dividends. And so before I move on, just one nugget of information. People ask me, Ian, why don't you talk about consumer non-cyclical that much anymore? Even though it's a huge percentage of my portfolio. The reason I don't talk about it on a day-to-day basis these days, stocks like Clorox, Unilever, Kimberly-Clark, Procter & Gamble, is right now they are all fairly, if not overvalued. And so they're not that exciting to me right now because of that. The other reason, though, there's two reasons why I'm not that excited about them, is they're huge. They are massive, massive positions in my portfolio. I have a more established portfolio. I'm further along. I've done what I need to do with a lot of these companies. They're huge. And so things would be different. If I were a newer investor, I were just starting out, I wanted to build the pillars, the core of my portfolio. I were trying to pick a consumer non-cyclical stock, and I saw Unilever at a PE of 22 in a market where most of its peers are trading even higher. Maybe I would look at Unilever. Maybe I would take a different approach with it. And so this is important wisdom that I want to impart to you, because I know I have a lot of newer investors here, and you're thinking about 2020, you're thinking about your 2020 strategy. Your strategy is probably going to look very different than mine because we're all at different stages in our journey. I'm at a different point in my journey because I already own a ton of Unilever. I just don't need to buy more. And in fact, I'd be better served to diversify elsewhere, like in oil, like in utilities, like in pharma stocks. There are other places, quite frankly, even real estate. Perhaps adding another real estate investment trust, or adding more to Realty Income if it ever went on sale, for example. But I am so heavy in consumer non-cyclical that I just don't need to add more, especially when the prices the valuations are a little higher. That said, hypothetically, if I were starting over again right now in next year in 2020 or right now in 2019, hey, I might look at it very differently, and I'd probably take notice of Unilever, that out of all of its peers, it's one of the better values right now. And with that, I want to do a peer comp, so I'm gonna pop this on the screen. I actually don't have Unilever in this, but I want to share some of the peers. Clorox, trading at a forward PE now. Mind you, forward, this with Unilever, I was looking backwards, and it's 22 backwards. Clorox is a 24.75 forward, so very expensive. Low yield, too, at 2.8, or low as compared to Unilever. Procter & Gamble, trading at 25.40 forward PE. Again, a lot different than a 22 backward PE. Kimberly-Clark is actually at about a 20 forward PE, so it's the cheapest of the bunch. But keep in mind, Kimberly-Clark, it's a harder comp to make between Kimberly-Clark, Procter & Gamble, Clorox, Unilever. I look at Unilever, Clorox, Procter & Gamble kind of is in the same boat. Kimberly-Clark should have a lower PE because it's more of a paper goods company. It doesn't have the breadth of portfolio in other areas of products, such as food, such as beauty products, such as shaving and personal care products, such as vitamins. Actually, Clorox has some vitamins. They've got Burt's Bees beauty stuff. Kimberly-Clark is more centered on paper goods, and so it's a I would say not as appealing of an investment from a valuation standpoint. It should always trade lower, and if it is not lower, something's wacky in the market. That's how I look at it, at least. But you see, Unilever, highest starting yield at 3.19%. I got 2.8 for Clorox, 2.4 P&G, 3 for Kimberly-Clark. So, again, hypothetically, if things were different for me, maybe I would take a serious look at Unilever here if I were just starting over and I would want a consumer non-cyclical foundational in my portfolio. I love Unilever. I do. And I love the international exposure it brings to my portfolio. By the way, I did a whole study on international exposure by stock for all of my positions. I'll link in the description below if you want to check it out. Now, being a year-end video, I want to look retrospectively again. What were my goals in not 2019, but 2018? It was buying Kimberly-Clark and Procter & Gamble. I did it because they were on sale. Let's look at that for a minute. I'm going to pop this on the screen. This isn't all of my tranches, but this is, I would say, some of my best tranches that I was able to acquire. And not only best, now that I come to think of it, these were the biggest. These were some of the biggest tranches I bought. So in May of 2018, it was a big month for me. I was spending a lot of money buying world-class stocks. And I bought a bunch of P&G at 73 and change. I bought a bunch of Kimberly-Clark at 102 and change. I'm up 71% on the P&G, not including dividends, just on capital appreciation alone. I'm up 33% on Kimberly-Clark. I am sharing these retrospectives again because going back to this question in the video about being concerned or stressed out about investing, when I historically have had a well thought through approach, I have tried to buy when stocks are on sale, I have looked at fundamentals, I have had a long-term approach, things historically, just speaking to my personal situation, have done really well. And so I don't think that will continue forever. There will be corrections. When there are corrections, I will step up to the plate and I will deploy capital because I know corrections create massive values. Quite frankly, as a dividend investor, it's not very exciting right now because it's hard to find value. I'm hoping for a correction. I want some more value. But anyways, retrospectively, it's important to share these real world results, these real world trades, because it shows to a newer investor or just someone stressed out what it's been like for someone like me who's been doing it longer. When I make wise decisions, I think through what I'm doing. I buy when stocks are on sale. I have been rewarded. And these are just a few more examples of that. And I'm really proud of them, especially when people are talking so much smack about Procter and Gamble, this and that. I don't want to get into it because people always get upset when I bring it up. But hey, I'm up 71%. I love you, Procter and Gamble. Thank you for all you do. All right. And so with that, I want to close out this video today. I want to move on to the last and final topic. And it really kind of, well, actually I have a bonus topic too, but it's more personal stuff. We'll get to that at the end of the video. But I want to talk about this. So, analysis paralysis. Someone was saying, I'm facing analysis paralysis. I'm feeling anxious. Already basically laid the foundation for this question. I want to share my framework, and I did a whole video on this, so I will link to that video in the description below. But I want to share how I look at this stuff. I'm actually going to jump around here. I want to jump to bullet point 4. I don't know if I'm going to share everything on the screen here because I got a lot of notes, but bullet point 4 is really important. I came up with this hack recently, and it's made me feel even better about what I'm doing. In my account now, I'm taking some of my dividends as cash. Some of that cash I'm actually using to pay bills. But some of the cash, honestly, is just accumulating in the brokerage account. I have a new hack. One of the biggest roots, I think, of investing anxiety is getting over levered. It's deploying too much money too fast, having no cash reserves, feeling stressed about it. What I have done that has made a world of difference is I do like to reinvest most of my dividends, but some of them I'm not. And the ones I'm not, some of them I'm using to pay some bills. Some of them, it's literally just stacking at this point up in my account, it's stacking up as a cash balance. This is coming from an investor who historically has had no cash balance in my brokerage. I've always deployed it all. I've always been fully in no cash in the account. Just seeing that cash there, just having that cash, it creates a little bit of calm. Seeing it grow over time too. It's creating peace and harmony and calm. And so this is just a little hack, but let your cash accumulate in your brokerage and don't deploy it. What I've been doing, quite frankly, like today when I bought 3M, is I will deposit more money into my account. I'm not tapping into the cash from the dividends. I'm just letting it kind of stack up. If I want to buy more stock like 3M, I'll put more money in the brokerage account and I'll use that net new infusion of capital. And just having that cash for whatever reason sitting there just creates a little bit of peace and calm. I like seeing it. So just a little hack for you. But some other stuff I want to talk about. I spend a lot of time keeping records. One of the reasons I do that is it allows me to kind of linger on each trade I make a little longer. As investors these days, it's kind of the equivalent of buying stuff with cash. When you buy stuff with cash, it's a lot harder than when you buy with credit card. That's why a common prescription for people who face credit card challenges or getting over-levered on cards is to get rid of the cards and start spending cash. One, it keeps them more accountable, but two, it's just harder to part with cash. Kind of same thing in the stock market. In the stock market, it's all digital. It's all kind of moving so fast. It's easy to spend, buy a lot of stock. Problem with that is after you do it, you can feel anxious if you have no cash reserves for emergencies, or if you just spent too much, you got ahead of your skis, you got ahead of yourself. And so for me, to avoid too many transactions, I just keep records. I like to look back. I like to think about, what did I just do? I like to loiter and give more give more meaning to each financial transaction. It just allows me to kind of give more weight to it, to spend more time on it. So I'm not thinking forward. I'm not thinking about the next transaction. I'm paying homage to the transaction that just happened. And so that's what some good records can do for you. Same kind of thing, but I just spend time, keep an investment journal, spend time reflecting on my transactions. If I spend time looking to the past, I spend time reflecting on the transactions I just made. I did it in today's video. I reflected on 3M. I reflected on historically what I've done with Realty Income. I've reflected on all Unilever and all the consumer non-cyclicals. Doing this reflection, you don't even have to be a YouTuber. You can have a journal. You can just spend time looking at the past. It gives more weight to what you've already done, how far you've already come. And it keeps you from getting too ahead of yourself, spending too much money in the market too quickly. Obviously, I think it's important just to stockpile some cash. There is nothing that takes away anxiety like having an emergency fund. Now, mind you, in my early days of investing, I didn't have an emergency fund. I was all in. I was rewarded for it. I consciously took on stress, and that stress paid off. It has a time and place. Now, as a family man with 2 kids, a wife, I could not imagine not having an emergency fund. It would be stressful for me. And so these days, I'm not taking on as much risk. I have an emergency fund. I stockpile cash. It is a good thing. It takes a lot of the weight off of my shoulders for any kind of correction. Dollar cost averaging is one way to mitigate risk. If you're looking forward to 2020, you're thinking about what if the market tanks? What if we're at the top of the market? I like to just buy monthly. I'm always buying stocks. If you look at my Twitter, I share there all the time, and my Facebook group, by the way. I share my trades. You'll see over time I periodically average in. It mitigates risk. Some months are up, some are down. Averaging in tends to optimize my buy price. I already talked about this a bit, but one way I mitigate risk is I look at value. What's currently a value now? Currently a value, at least a reasonable value, is 3M. That's why I'm buying it. It mitigates risk buying at a reasonable value. If I were to go out and buy Clorox now, I would feel a little more anxious. Maybe, well, I wouldn't, because Clorox, oh my God, I love Clorox. But never feel anxious about you, Clorox. I love you. But something like that, trading at a higher PE, I just don't get anxious about it anymore. But I just wouldn't do it because it's not a value. It's bringing more risk to my portfolio. But things would be different if I were just starting over. I would just go for quality, quite frankly. Hypothetically, just my personal situation. I own a lot of stocks. I own 43 dividend stocks. I diversify to mitigate risk. It allows me to sleep at night. Broad representation across industries, different types of companies. So that's a good thing. Helps me out. I'll tell you, the dividend strategy alone, I think it is calming and peaceful, because when someone is a dividend investor like myself, I'm only looking at cash flow. Cash flow, generally speaking, goes up and to the right, whether the price per share is up or down. And quite frankly, if price per share is down as a dividend investor, I get excited because I get to buy more yield with my money. Share price goes down, starting dividend yield goes up. So it's good for dividend investors. But honestly, I don't really look at my aggregate net worth portfolio value that frequently. And I don't do it because I don't care. It doesn't matter to me. What matters to me is the cash flow, though. That's what I look at regularly. And by focusing on something like that, that has real meaning and that tends to go up and to the right, it is so peaceful and calming for investors, in my opinion. One thing, quite frankly, that I've historically done is I've focused on sectors that tend to perform in any economy. I'm talking about consumer non-cyclicals. I own some restaurants, fast food. Everyone needs to eat. Utilities. Everyone needs energy. Oil companies, shout out. Everyone needs energy. This world runs on energy. And so I do own some stocks that are more cyclical in the industrial space. One in the technology space that's a little more cyclical because it's tied to B2B purchases. Those, though, are a smaller percentage of the overall portfolio. And so you may want to think, if you're a nervous investor, it may make sense to skew towards sectors and investments that tend to perform well from a business standpoint, regardless of economies, economic cycles, and so forth. I like to consistently deploy small amounts. And so I'll tell you, people sometimes think you have to deploy all this money to have meaningful results. I think the opposite. Baby steps. It's all about baby steps. I did a whole video on this, how a lot of my transactions over the years, they've been smaller dollar amounts. I did a whole study on this. Small dollar amount transactions add up to big results over time. And so don't feel like, oh, you have $5,000 or $10,000, it all has to get deployed. Maybe start with just a few hundred. See how it goes, and then just keep averaging slowly and methodically over time. And so starting small, in my opinion, and actually respecting the small investments, giving weight to them, thinking about them. In my opinion, that's such a good strategy. And again, though, to close out, start thinking more spiritually, like I did with the oil example, the way I like to look at it as well is I'm investing in businesses, I'm investing in people, I have faith in the people. And from a spiritual basis, I feel like I am doing a good thing. I am backing good people with my money. And so that's a whole nother way that I just don't worry about this, because all of us in this world, one way or another, are connected. We're all important. We're all here for a reason. And I pray that everyone fulfills their purpose on this planet. And I like to use my finances to drive cash flow for me and my family and our charitable contributions as well. But I also like to use the capital to support companies that employ people that are working hard, that are doing amazing, amazing things out there. And you think about it holistically like that, it opens up kind of a new way of looking at investing anxiety for 2020. All right, everyone. Well, actually, before that, it's also okay to be yourself. If stock market investing is not for you, it's not for you. So just be true to your heart. That's the last one I wanted to point out on here as well. Before I leave today, and we're at the end, by the way, Merry Christmas, everyone. I want to share something with you that is on my mind. I get these comments from time to time. Ian, I can't take you seriously because you got some crummy bricks behind you. And where's your fancy car? Where's your bling bling? Where is it? Well, I'll tell you, this is not even real bricks. This is a backdrop in my garage. It's a piece of fabric that looks like bricks. I, as an investor, as a person, as a human being, when I see stuff out there that is trying to bring credibility to itself through flashy cars or big houses or money or bling bling, that kind of stuff, I literally just look right past it. If you're out there, you're trying to think, and it's not only about my YouTube channel, about anyone else's channel. You're trying to wonder, should I listen to this or not? I thought this goes without saying, but I just got to say it. Look the person up and look at their credentials. I'm wearing, by the way, my Stanford class ring here today. I'm a Stanford University graduate, computer science. Here's my ring. It's got a little computer on it because I did my computer science degree. Look at the education of who you're listening to, but not only the education from a university or schooling perspective, but look at their self-education. Look at their street smarts. Look at their employment history, what they've done, but also listen to what they're saying. And so, quite frankly, the reason I do this stuff low budget is because I want it to be focused on the message. That's what's important. And I don't share my portfolio value. I could. I don't want to, because I want to keep, honestly, for my own privacy. I just don't feel comfortable sharing it out there. It's my business. But also, I don't need to share it. It has no ramifications on anyone else other than me. Same thing. I don't need to show anything flashy here. I want the merit of this channel to ride on the quality of the analysis, the content, the wisdom that comes across. And the education that I've had both formally and on the job over the years, all of that should support the analysis that I'm doing and sharing. So if you're out there, you're asking this question, Ian, why don't you have the flashy cars in your videos, this and that? That is why. This is a channel that its success will depend on the quality of the content and nothing else. And if you are out there and you try to gravitate towards that type of stuff, I like to watch it sometimes too. Honestly, I'm on YouTube. I like to watch some car videos from time to time. That's kind of my own personal like junk TV, if you will, like junk food, is watch it for fun. But think about it. When you're watching that stuff, you can do it, but you may want to just think, why are these people sharing these cars? Why are they sharing these things? What are they really saying? And so for me, at least, what's most important that I want to convey to everyone, and what I want my reputation and my legacy to ride on, is the quality of the wisdom, the analyses that comes through. And so that's why. And quite frankly, I'm a thug life investor. I like to be frugal, save money. So I got more money to put in the stock market. And so I've got the scrappy camera set up, and I love it. I love it so much. All right, everyone. I love you all. Merry Christmas. Happy New Year. Wishing you all the best in 2020. Before I leave today, in terms of full disclosure, I own the stocks mentioned today. I am long 3M, ticker symbol MMM. I am long Realty Income, ticker symbol O. I am long Unilever, ticker symbol UL. Clorox, ticker symbol CLX, Procter & Gamble, ticker symbol PG, Kimberly-Clark, ticker symbol KMB, Chevron, ticker symbol CBX, Royal Dutch Shell, ticker RDSA, and BP, ticker symbol BP. I own all of those stocks in my personal dividend stock portfolio. And in terms of a friendly disclaimer, I am not a licensed investment advisor. Today's video is not investment advice. Please consult a licensed investment advisor before making any financial decisions. I'm just sharing my personal journey here on YouTube for fun and entertainment purposes. Also, today's video is not tax advice. I'm not a licensed tax advisor. Please do consult a licensed tax advisor before making any tax or investing related decisions. And I have additional disclosures, disclaimers in the description below, as always. Thank you, everyone, for all of your support this year. We are almost 50,000 dividend investors strong. 2020 is going to be the best year ever for this community. We are going to have more meetups than ever before. Wishing you a Merry Christmas and Happy Holidays.